This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stocks surge. The market heats up on a new report that the trade war with China may be thawing.
Forgotten middle child, investing for the long term, why mid-cap stocks may be your best bet.
Stressed out? How to make sure your investment decisions are not as volatile as the market. Those stories and much more tonight on Nightly Business Report for this Friday, January the 18th.
Good evening, everyone, and welcome. As you know, the market loves hearing about progress in trade negotiations with China, and today that's exactly what it got. There are reports that the world's second largest economy has offered to go on a 6-year buying spree to increase imports from the U.S. The goal? To zero out China's massive trade surplus. Investors have been looking for signs that the trade war may be easing ahead of a key meeting between U.S. and Chinese officials later this month. And that sent stocks soaring. The Dow rallied 336 points to 24,706. The Nasdaq added 72, and the S&P 500 was up 34. The major indexes posted their first 4-week win streak since August. Kayla Tausche has more on the trade talk that drove today's rally.
The market is zeroed in on what will be on the table when top economic officials from the U.S. and China meet later this month. It all began at the G20 in December. Each side gave a list of demands, suggestions, and non-starters. I'm told those G20 discussions are where China proposed a massive increase in purchases of U.S. goods through 2024. That 6-year time frame was not a coincidence. China's pitch was that the purchases would span President Trump's re-election campaign and his potential second term. China hoped that would resonate with Trump, who rejected previous offers focused solely on imports. While the reported price tag of the potential buying spree, $1 trillion, would cut the annual trade deficit with China in half over the next 6 years, it's unclear whether China would agree also to tackle thornier issues of intellectual property that started the trade fight in the first place.
On the one hand, they may have a short-term deal that provides some money and some boost for the market. But the longer-term problem is the fact that we're on a collision course, particularly in the emerging technologies.
The Chinese have drafted a new foreign investment law prohibiting the use of forced technology transfer, but the U.S. so far has dismissed that as meaningless without strong enforcement. For Nightly Business Report, I'm Kayla Tausche in Washington.
That trade talk clearly juiced the market today, and it's one of the reasons why investors are thinking about this market in a different way than they did just a few weeks ago. Bob Pisani explains.
The markets are resetting higher. We've gone from fears of zero or negative earnings growth in 2019 at the end of December to a consensus that earnings will now grow in the low single digits for 2019. We've gone from fears that a recession was developing in the latter part of 2019 to a feeling that this is very unlikely now. So the danger now is that the rally may be getting ahead of itself. The good news is this: trade talk rumors are giving another leg up to an already healthy rally. The bad news is the markets are now pricing in a favorable trade deal, and the markets are increasingly vulnerable to a disappointment or sell the news situation. S&P 500's moved 50 points, the Dow Industrial's 500 points since mid-afternoon Thursday when the Wall Street Journal first reported some progress on China trade talks. Other reports Friday indicated that China may be making trade concessions, including an offer of a 6-year increase in U.S. imports. Another report says the deal would aim to reduce the trade deficit with the U.S. to zero by 2024. Maybe, because we've already had a significant move up already, the market's vulnerable to a couple risks. First, there's no trade deal. Or second, that even if we get a trade deal, the market will sell on the news and that there'll be very little, if any, reaction in the markets. There's one other problem. A major trade deal could have ripple effects on the U.S. economy. Hopefully more trade will be beneficial, but there may be one other less desirable side effect. If you get a major trade deal, bond yields could start to rise, and the Fed may start to get a little more aggressive, raising rates. That's a separate problem. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So far this year, all of the major indexes are sharply higher. But did you know that over the long term, mid-caps outperform both large caps and small caps by a lot over a 10-year period? And according to FactSet, if you extend that time frame to 25 years, mid-cap stocks gained more than 1,300%, while the S&P 500 gained about 800, and the small caps added roughly 1,000%.
So we decided to shine the spotlight on this group of stocks that tend to be forgotten. Joining us tonight is Mike Bailey. He's Director of Research at FBB Capital Partners. Mike, good to see you. Welcome back.
Thanks for having me back.
I know why you invest in large caps, maybe stable growth, predictable growth, maybe a dividend as well. I know why you invest in small caps. You're trying to get in early on a company's maybe a greater growth rate. Why do you invest in mid caps?
So mid-cap, it's a great place to play. I think if you want to own a diversified portfolio, you got to own mid. You really, small caps are great, just like you said, but I think you really want to own sort of all the pieces in that pie, really. So you want to own sort of some large, stable companies, maybe some small, riskier, high-growth companies, and something in the middle, just sort of balance that out. So we do think it's a good place to be. At the current moment, we own a little bit less mid-cap, a little bit more of the large, but we can get into some reasons why now might be a little bit of an attractive time for some folks. If you don't own mid-caps, it could be an interesting time to start to look at it.
Does it help smooth out volatility?
It generally does. And so, as you can diversify your portfolio more, that really helps out. So if the only thing you own is large cap, you start to plug in mid, that's a very good thing. That really helps to diversify that volatility, gives you a little bit more returns, as you talked about in the beginning. So it's helpful. I think the question is, what's the optimal kind of setup or the optimal mix? And we can sort of get into that. But I think it's very helpful to own some mid for sure.
Large caps, you tend to have the smaller price to earnings ratios, the bigger price to earnings ratios with the small caps. What about mid caps? How do you evaluate when it's a good value or a good growth opportunity?
Absolutely. So generally, like you said, it tends to be sort of, as you think about risk and return, mid caps, kind of as the name suggests, it's kind of right there in the middle. So you get a little more growth. It is a bit more expensive than sort of the safer large cap names. So the way we think about it, we generally do own a little bit more large cap. We certainly own some mid. The question is timing. So right now is actually kind of an interesting time to own mid caps. We've seen the whole market really kind of get crushed with that, Grinch Christmas Eve bear market. It's come back a little bit. Really, the large caps have come back a lot more, and that leaves the mid caps. They're really just sitting there. So there is an interesting opportunity. If the whole market comes back, you're probably going to see mid and even small caps come back pretty meaningfully in the near term. The question. Go ahead.
We got to go at this point, but I'm just curious. I know people are out there saying, well, wait a minute, how do you define a mid-cap? So before you go, very quickly, what is the market capitalization range top to bottom for mid-caps?
Sure. Textbook definition is 2 billion market cap on the low end, up to 10 billion. So anywhere between 2 and 10, that's what you want to own for mid-cap.
Very good. Mike Bailey, thanks. Have a good long weekend.
Thank you.
Mike with FBB Capital Partners.
The president of the New York Fed is calling for patience and good judgment before raising interest rates. John Williams today cited anxiety about the pace of economic growth, adding his voice to what other central bank officials have been saying about a less aggressive approach to monetary policy. He said being data dependent is more relevant than ever.
And the latest read on consumer sentiment has dropped to its lowest level since the 2016 presidential election. That survey from the University of Michigan cited growing concerns over economic growth. Other economists say that the partial government shutdown and tariffs are also weighing on consumers' moods right now. Separately, a new report says that industrial production posted its biggest gain in 10 months in December. The results were helped by a rise in motor vehicle production. Manufacturing activity, you may know, accounts for about 12% of economic activity.
President Trump will hold a second summit with the leader of North Korea next month. The announcement from the White House followed a meeting today between President Trump and a top North Korean official. The two leaders first met last June in Singapore. A location was not given for the next summit.
The head of the Food and Drug Administration is warning that the government shutdown may force his agency to make some hard choices. During prepared remarks at a hearing, Scott Gottlieb called this a watershed moment for the FDA.
We're in unfamiliar territory. It's a watershed moment for the life of the agency, and we'll come out of this, I think, much stronger for having grappled with this challenge together and having prevailed. But the road between now and the end will be marked by continued challenges and hardships for our people and continued impacts to our work as we focus on preserving our functions.
And the partial government shutdown is coming at a bad time for some entrepreneurs as they try to get their small businesses off the ground. Kate Rogers has our story tonight.
Elizabeth Wynn was in the process of launching her hot sauce company, Del Sauce, when things suddenly came to a halt. Wynn and her husband, Gonjo, make the sauces in a commercial kitchen in the Richmond, Virginia area. Wynn says her contact at the FDA is now furloughed, putting the approval the startup needs to move forward on hold.
I feel a little bit like political pawns right now because, yes, border security is important, but we don't have anything to do with the border security right now. We are just trying to open a hot sauce business.
In a statement, the FDA said while we cannot speak to this specific situation, only certain FDA food operations continue to the extent permitted by law, such as activities necessary to address imminent threats to the safety of human life. Meanwhile, outside of Pittsburgh, Amanda Silk is worried about the growing backlog at the Small Business Administration, or SBA, when it comes to loan approvals. Silk is in the process of opening a fitness studio franchise, but she needs a $350,000 loan from the federal agency. She's just a few weeks away from signing a general contractor and closing on the loan, but is concerned that her project will be delayed. Silk's broker told her and other franchisees to prepare for disruptions through the first half of 2019 due to the partial closure.
I have no control over what's happening in the government right now, and I feel like my business is being held hostage. My business isn't political, it's a fitness studio, and I feel very helpless and very hopeless.
In a statement, the SBA said in part that the agency is providing assistance to small businesses in the form of low-cost, long-term loans for equipment and real estate, which were approved prior to December 22nd. Once full operations are permissible, the SBA is fully prepared to handle higher volume of loan requests to satisfy any unmet demand. Until then, it's a waiting game for entrepreneurs ready to get their businesses off the ground. For Nightly Business Report, I'm Kate Rogers.
Time to take a look at some of today's upgrades and downgrades. We begin with shares of Chevron, which was upgraded to buy from neutral at UBS. The analyst says that the recent pullback in oil prices has presented a buying opportunity in Chevron shares. Price target now $135. That stock rose 2% today to $114.37. Kimberly-Clark was upgraded to overweight from neutral at JP Morgan. The analyst says that price hikes, cost savings, and abating inflation will be good for margins for that company. Price target is now $129. Company is scheduled to report its earnings next week. Meantime, the stock gained about 2% to $116.87.
Interpublic Group was downgraded to sector perform from outperform at RBC. The analyst expects organic growth to decelerate this year after recent account losses. The price target is $24. The shares fell a fraction to $22.25. Signet was downgraded to sell from neutral at Citi. The analyst says Signet is vulnerable to an economic slowdown. Yesterday, we told you about Signet's weak holiday sales. The price target is $20. Nonetheless, the stock rose 1% to $25.41.
Still ahead, why Tesla's road ahead looks bumpy.
Facebook's privacy lapses may result in a record fine. According to the Washington Post, the FTC is reportedly considering a payment in excess of the $22.5 million imposed on Google in 2012. The FTC announced an investigation into Facebook back in March when it was accused of misusing the personal information of its users.
OPEC slowed its oil production in December. In fact, it was its biggest monthly output decline in 2 years. According to the International Energy Agency, that decline was driven by Saudi Arabia, of course, the world's largest crude exporter. Like stocks, oil prices today also got a lift from the news on U.S.-China trade. Domestic crude settled up about 3% today.
America's most popular vehicle is going electric. Ford is planning an all-electric F-150 pickup truck. The automaker said engineers have begun working on a more efficient vehicle that will come with more power than traditional gas and diesel trucks. Now, the timing of when it will be available, that's up in the air.
Meantime, Tesla is cutting 7% of its workforce. The electric automaker says the move is needed to help the company turn a profit while it makes lower-priced models. But investors don't seem to be on board. He sent the stock down about 13% today. Phil LeBeau has details for us.
For all the glitz surrounding Tesla and its electric cars, at the end of the day, this is an automaker barely turning a profit, so it needs to keep costs in check, which is why CEO Elon Musk says he's made the difficult choice of cutting 7% of the company's workers, roughly 3,100 people. In an email to employees, Musk wrote, "While we have made great progress, our products are still too expensive for most people." That includes Tesla's Model 3, which, on average, sells for more than $50,000. Musk wants to sell a version of the Model 3 for less than $40,000. That means bringing down production costs, from the battery pack to the assembly line. Last year, as Tesla raced to boost sales, it hired scores of workers and added production by erecting a permanent tent in its parking lot, where it built more Model 3s. The surge in production helped Tesla boost deliveries and, in the process, turn a profit.
Mr. Musk surprised Wall Street by posting a profitable quarter in Q3. I think he wants to do that in the future while he takes costs down. He's doing a little bit of right-sizing.
Musk says Tesla will likely turn a profit in the fourth quarter, though it may not be sizable. And with the company developing new vehicles like an electric semi and an updated version of its Roadster, the question now is whether Tesla can bring down costs while boosting sales. In the end, Tesla's fortunes will come down to whether it can be more efficient while consistently turning a profit. Phil LeBeau, Nightly Business Report, Chicago.
The Grinch visited Tiffany's, and that's where we begin tonight's market focus. The upscale jeweler reported holiday sales fell from a year ago and gave a downbeat full-year outlook. The company blamed a decline in sales to foreign tourists, primarily Chinese. But some analysts remain upbeat on Tiffany's long-term growth, and that helped the stock gain 5% to $89.82. The apparel maker VF Corp raised its full-year revenue and profit forecast. This as demand for high-margin popular Vans sneakers helped lift sales. VF Corp spent the past 2 years cutting inventory of Vans and launching new lines of sneakers. The shares gained 12% to $82.34. State Street plans to lay off 1,500 workers to cut costs and automate more of its businesses. About 100 senior management jobs will be affected. The aim is to shed $350 million in expenses this year. The shares rose a fraction to $71.30.
CVS and Walmart have settled their differences, and they've reached an agreement on a pharmacy contract. CVS said on Monday it expected Walmart to leave the drugstore pharmacy benefit network because the two companies could not agree on pricing. But the companies did not disclose the terms of this new agreement. They said it covered multiple years, though. CVS gained 3% today to $65.52, while Walmart was up 1% to $97.73. One of Eli Lilly's cancer drugs has suffered a setback. The company said that its sarcoma treatment did not significantly improve the overall survival of patients in that trial. The drug had been approved back in 2016, but a continued approval was dependent on further study to confirm its benefits. Lilly is now discussing what comes next with regulators. Shares dropped 2% today to $116.59. And Schlumberger reported quarterly revenue that topped estimates. It also said it sees international growth in 2019. But given the volatility in crude, the CEO says his company's spending outlook remains uncertain. Schlumberger is considered a bellwether for the oil field services sector, and that stock popped by about 8% today to $44.73.
Time now for our weekly market monitor, who has a mix of large and mid-cap companies that he sees growing double digits over the next year. He is David Rainey, portfolio manager of the Hennessy Focus Fund. David, welcome back. Nice to see you again.
Thank you. Good to be here.
And you picked these from different industries, and you say that basically they're all going to grow considerably over the next couple of years. Let's start with your first pick, which is American Tower, a big cell phone operator with international aspirations.
Sure. American Tower is this country's largest cell tower owner-operator. They both acquire and build sites. The U.S. market is running and gunning right now. All 4 wireless carriers are aggressively rolling out services and technology and building out spectrum. The U.S. market is very strong. They also have a very large presence overseas and select emerging markets. And so we're confident that their rate of compounding, this kind of mid-teens earnings growth, should be able to continue for well into the next 5 years. It's been a top holding of ours for years, and we look forward to it being in the fund for a long time.
Another one, a big holding of yours is CarMax, the big used car seller. It's had a tough time here, starting to come back. What do you make of this company right now?
Well, used car sales ebb and flow kind of in sync with new car sales. They've been a disruptor in the industry for the last 20 years. They've been a mid-teens compounder for the last 10. And they're actually right, today they're kind of first inning of rolling out a new nationwide omni-channel selling strategy, which we think will help them address the millennial market, address those car buyers who like to do their research and their buying and their financing online. And so within the next year or so, they will have rolled out this omni-channel strategy across their 200 stores. They'll continue to build stores. They'll have the same store sales growth, and we think they will continue to be a disruptor in what is a very, very large industry.
And another industry that is growing involves Hexcel Corporation, and it basically designs and manufactures lightweight performance composites. Why do you like it?
Absolutely. Hexcel is in a part of a global oligopoly that designs and create structures using carbon fiber composites and building blocks. And these products are increasingly being used by Boeing and Airbus in the commercial aerospace industry, in specialized defense, industrial, and wind energy applications. Once a product is designed into an aircraft and airframe, it's there for the next 20 years.
Okay.
It's FAA certified, and consequently, there are very high barriers to entry for competitors, and they're very high switching costs for manufacturers. So we think it too is poised to generate mid-teens earnings growth for the fund for the foreseeable future.
David Rainey. David, thank you.
Thank you.
David's with the Hennessy Focus Fund. Coming up, keep calm and invest on. How to make sure your emotions don't get the best of you in this up and down market. And with the markets closed for the Martin Luther King Jr. holiday on Monday, here's what to watch for on Tuesday. Dow Components, J&J, Travelers, and IBM report their earnings. The World Economic Forum in Davos will be underway. It attracts business leaders from around the globe, and the market will have its first chance to react to China's economic growth report. That is what to watch for on Tuesday.
As you well know, the market has been giving investors whiplash for months now. It started in early October when stocks began that steep decline. The Dow fell by 17% until that trough on December 24th. Then a sharp turnabout. It has been roughly 10% higher since that time. It's enough to make any investor feel strong emotions, from anxiety to enthusiasm. But financial planners and money managers always advise to take emotion out of the investment process. How do you do that? Our guest has a little different take on that tonight. Tim Maurer is Director of Personal Finance at BAM Alliance. Tim, thanks for joining us tonight.
It's my pleasure.
You say don't avoid emotion, but face your emotions. What do you mean?
Yeah, we can't avoid emotions. We can't treat them as the enemy. It's a biological imperative. So instead of trying to take emotions out of the picture, I invite investors to address their emotions, to understand the degree to which they can handle market volatility, both on the downside and on the upside with the fear of missing out, and then to customize a portfolio based on their unique ability, willingness, and need to take risk, understanding the emotional component as opposed to ignoring it.
And you point out that the pain of losing impacts us twice as much as the joy of gain. And it leads us to that fear of missing out.
It certainly does. And I'll give you a great example of this. When was the last time you called your financial advisor to say, hey, I just wanted to thank you for the great job you've done allocating my portfolio. I've noticed it going up recently. That doesn't happen quite as much as when people call their financial advisor to ask exactly what's going on in the market when the market's going down. So that's a good example where you can see precisely how this works. And it also does take into account the fear of missing out. For example, in December, the market was going down and people were worried.
Right.
Now, if they happened to get out of the market and they see it going up, they also may feel that same pain of missing out on this new upturn.
But you also have to know your risk tolerance. If you're losing more than you're comfortable with, you're going to become very emotional, right?
That's a great point, Bill, and it's probably the most important factor for an investor to look at. I'm not suggesting investors just go 100% equities and then white-knuckle it through any sort of market downturn. No, in fact, it may well be that your past history with investing will teach you how much volatility you can withstand. Then I recommend establishing a portfolio that is designed specifically to help you deal with that. So don't have everything in equities. Most people can't handle the full brunt of the market.
Yep.
Balance that out with the right amount of conservative bonds.
Tim Maurer, I feel calmer already, by the way. Thank you for joining us tonight. Tim Maurer with BAM Alliance joining us.
Thank you.
And before we go, a final look at the day on Wall Street for this Friday. The Dow rallied 336 points. The Nasdaq added 72, and the S&P 500 was up 34. The major indexes posted their first 4-week win streak since August. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Watch out for that big snowstorm in that parts of the country that's coming your way. Have a good weekend. We'll see you Tuesday.